Welcome back to Stock Trader School, from rookie to Rainmaker, and this is Market Mindset Mondays, the place where future billionaires come to get inspired. And today, we're kicking off our series for traders with a special edition of Market Mindset Mondays. Confidence is good. It's the lubricant that keeps your self-doubt and insecurities from grinding your progress to a halt. But like all good things, it becomes toxic when it clouds your vision, preventing you from seeing the obvious. If you protect yourself on the downside, you don't have to swing for the fences. You start deviating from your well-honed strategy, taking on more risk than usual. But here's the twist: you still think you're in control. Welcome to the illusion of control. A company has been on a downward trend for months, but you spot a glimmer of hope, a recent surge in quarterly earnings that defies the negative market sentiment. Feeling confident in your newfound insight, you decide to invest heavily in this stock, expecting it to rebound based on its improved performance. However, what if the stock continues to decline despite the better earnings? It's a cognitive bias that causes traders to overestimate their abilities, leading them to take on excessive risks and make irrational decisions. This cognitive bias describes the tendency for individuals to overestimate their intelligence or expertise in a particular area. In trading, this can manifest as a trader believing they have a greater understanding of the market than they actually do. When a trader becomes overconfident in their abilities, they may fail to recognize the inherent risks involved in trading and investing. This lack of foresight can lead to catastrophic losses when the market takes an unexpected turn. It's designed to help you stay grounded and make rational decisions by asking you thought-provoking questions that challenge your assumptions and biases. This checklist is your secret weapon in the battle against overconfidence. Download now and trade smarter, not harder. For instance, a trader who ignores the possibility of a market downturn may find themselves caught off guard when a recession occurs, resulting in substantial financial losses. For instance, a trader who experiences a few winning trades may become overconfident, thinking they have actually cracked the code to making millions in the market. They might start taking on more risk than they can handle, deviating from their trading plan and ultimately leading to substantial losses. You've just encountered the efficient market theory. This economic theory suggests that stock prices already reflect all available and relevant information, making it nearly impossible to consistently beat the market. In the context of trading, recency bias can cause traders to focus too much on recent price movements and ignore broader market trends or fundamental analysis. For example, a trader who witnesses a significant increase in the price of a stock may become overly optimistic about its future performance, disregarding any underlying economic or industry challenges. This bias can lead to FOMO, or the fear of missing out, causing the trader to invest heavily in the stock, only to see their investment decline when the market corrects. Playing safe makes good sense, but the path to financial success is fraught with psychological pitfalls, and even the most seasoned traders are not immune to them. As human beings, we tend to rely on recent experiences and readily available information when making decisions. Implementing strategies to overcome them, such as using a pre-trade routine, keeping a trade journal, and seeking feedback from other traders, can help you stay grounded and make rational decisions. Remember, while overconfidence may lead to short-term gains, it's often followed by a harsh reality check that can set your trading back. By understanding and addressing this issue, you can pave the way for long-term success in the world of trading. By understanding the cognitive biases at play and recognizing the limitations of faulty reasoning, efficient market theory, and the availability heuristic, you can navigate the markets with a clear and discerning eye. Remember, the true essence of trading lies in embracing calculated risks, staying adaptable, and making informed decisions based on a comprehensive analysis of the markets. Don't let the illusion of control lead you down a path of impulsive actions and potential financial ruin. Instead, arm yourself with the knowledge and discipline to see through the facade and stay grounded in the face of market volatility. When you witness the dramatic rise of cryptocurrency prices, you might jump to the conclusion that this market is poised for exponential growth. But remember, not all markets operate the same way, and past performance is not indicative of future results. In this high-stakes game of trading, when confidence turns into overconfidence, it can wreck your trades and derail your entire trading career. We Lines explore the sneaky ways in which overconfidence can creep into your trading and leave you vulnerable to making disastrous decisions. And we Lines equip you with the tools to spot these red flags early, so you can avoid becoming another statistic. Just like a skilled magician, this illusion can divert your attention away from critical factors, leading you to make decisions that seem sound at the time, but ultimately result in disastrous consequences. Imagine you're at a roulette table in a casino, watching the losing streak of black numbers continue to pile up. According to the law of averages, you reason that red must be due. When red finally wins, you bask in the glow of your successful prediction, feeling like a master of the game. But in roulette, each possibility is still a viable option in the next game, regardless of what won the last round. You've fallen prey to the fallacy of faulty reasoning or faulty reasoning. This common cognitive bias tricks you into thinking that past events can influence future outcomes in random events. By the end of this session, you lines know how to recognize the warning signs of overconfidence and stay grounded even when the markets are roaring with excitement. So buckle up, because we're about to take you on a wild ride through the psychology of trading. As legendary investor Warren Buffett wisely said, the first rule is to protect yourself from needless losses. You don't need to be an aggressive trader. This week, we're pulling back the curtain on the dark side of confidence. You've had a couple of winning trades under your belt, and suddenly you're feeling invincible. In the realm of trading, the illusion of control is a sneaky psychological trap that can make you feel like you're in charge, but in reality, you're at the mercy of your own biases and emotions. Now let's shift our focus from the roulette table to the stock market, but the story doesn't end there. Let's introduce another key player in this drama, the availability heuristic. In the exhilarating world of trading, it's crucial to remain vigilant against the deceptive allure of the illusion of control. The overconfidence effect is a pervasive issue in trading that can lead to significant losses and derail your overall trading career. Let's delve deeper into the 3 cognitive biases that contribute to the overconfidence effect. The first is the Dunning-Kruger effect. Next, we have recency bias. This bias refers to the tendency to give more weight to recent events or data points when making decisions. Finally, risk blindness is a cognitive bias that causes traders to underestimate the potential risks of their decisions. Recognizing these cognitive biases is the first step towards mitigating their impact on your trading. And that's all for today on Market Mindset Mondays. You can find more on our videos listed in our channel. Thank you for watching. Don't forget to like and subscribe for more content.